Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about lessee accounting under the 2016 lease rules. We've talked about how you determine for the lessee whether the lease should be financing or operating. We've done the journal entries for all of them. We've done the amortization. We've talked about what we do at the end of the lease and how it's different when there's a bargain purchase option or transfer of ownership versus a traditional lease. Now that we've wrapped up a discussion of the lessee, it's time to talk a little bit about the lessor. And we're going to start by determining whether it's a sales type or operating lease for the lessor. Now, under the lessee accounting, we've got financing versus operating. For the lessor, it's a sales type or operating. A sales type lease means that essentially you have sold the asset to the lessee. They now own it. And you can see that they're the same exact requirements or thresholds or rules that we talked about with lessee accounting. And that's one of our key concepts, is that even though the classification names are different, the basic rules are the same. Doesn't mean they'll always come out the same. I mean, if the lessee is using 10% interest and the lessor is using 6% interest, the lessee could think that they're not paying the majority of the fair value, while the lessor thinks they are. So the lessor might think it's sales type, while the lessee thinks it's operating. So we can get different classifications that way. We used to get different classifications under the old rules as well. And what would happen in the old rules is the lessee would say, oh, for me it's an operating lease. I don't have to record the capital asset because it's operating. So no asset, no liability. The lessor would say, oh, for me it's capitalized or sales type. I can show that this asset is now off of my books. And from an accounting perspective, poof, that asset was just gone. It didn't appear anywhere because the lessor had written it off and the lessee hadn't written it on. It's just gone. That was one of the problems that FASB wanted to address with this new set of rules. Now you can actually show it on both sets of books, because if we look at the rules, you'll see that while both create an amortization table, one records this new net investment in the lease, that's a special kind of asset, and gets the asset off of its books. An operating lease doesn't. So that asset is never written off of the lessor's books, even though it's written onto the lessee's books under both options for the lessee. So now, instead of having the asset disappear, we've got the asset on both the lessor and the lessee's books, depending on how each classifies them. Other than that, you'll notice we record lease payments and accrued interest. We don't have any amortization or depreciation on a sales type because I don't own the asset anymore. I sold it to the lessee. On an operating lease, I have a payment that I'm receiving. I have lease expense that I'm recording because of these initial direct costs that I'll slowly amortize away. And then, of course, I've got my amortization, and I'll also have some lease revenue that I record. It's not listed here, but that's part of that lease payment. Finally, we'll record the transfer of the asset out of a net investment to asset when I get it back, or when I sell it to the lessee. Or on an operating lease, I keep the asset. I've already got it on my books, so I'd only record the sale of the asset later on when it's applicable. Now, I do want to mention that there actually is a third category for lessors. It's called a direct financing lease. We're not going to talk about it too much because the accounting is very complex and because it's not used as often as these other two. So I just want you to conceptually know that there is a third category. This category really only kicks in when the lessor or the lessee has an insurance company or other third party that guarantees a residual value. So for example, that Cisco versus Hanford example that we looked at had a market value of $300,000, a residual of $100,000. Hanford didn't guarantee that. They could have run it into the ground and Cisco would have just been out of luck. Well, what Cisco or Hanford might do is they might contract with an insurance company and say, we'll pay you a certain amount now and you guarantee that it will be worth $100,000 when we're done as part of this contract. And either group can pay for it, but there's a third party involved. And if there's a third party that has guaranteed the value of this payment, and between what the guarantee and the future value and the present value of these future payments are worth comes out to the majority of the value of the asset at the beginning, then you might get direct financing. And the accounting requires several intense calculations and several tables to figure out. It's a lot of fun, but it's more fun than I think we have time for. So conceptually, just be aware that if there's a third party involved that ensures that the asset will be worth a certain amount at the end, then there's another category that you would need to research and look into to make sure you did the accounting properly. We're not going to get into that, but just be aware that it is there. So with this focus on sales type and operating, we need to do an example so we can see how they come together. And we need to start with an amortization table. So first off, here's the problem that we're going to look at. Same exact scenario as we did before. Hanford and Cisco, only this time we're going to focus on what Cisco was doing. So with that, I'm not going to go back through the numbers. They're the same numbers as we had before. You can pull them up yourself. Let's jump right into our amortization schedule. And you can see here that I've put in some of the numbers for us. There's our payment amount, the market value, the estimated residual that Cisco believes it's going to get after the lease, interest rate that Cisco is charging, that's that 4%, and the number of payments that Hanford will make. Now I need to fill in the right side of this amortization schedule. And the first thing I'm going to do is put in those initial direct costs. And we already know those. They're $4,000. My next box is the amount needed from the lease. Now, this is a really important calculation, but it's not one that we're going to worry about right now. We're going to save that fun till later. Conceptually, though, just so you're comfortable with what goes here, we want to make sure as a company that we get the market value out of this asset. I could sell it for $300,000. I'm going to make sure I get $300,000. I'll get some of it by selling it off, or in some cases releasing it for that $100,000 estimated residual value later on. So I do some calculations with time value. I figure out what piece of the $300,000 has to come from the lease. I put that number in there needed from lease, and then I calculate the amount of my payments. So again, we're not going to do that right now because we already know the payments are $56,825. So we'll just go ahead and move on, but be aware that we're going to get to that as we move forward with our discussion of leases. The next thing we want to talk about is our implicit interest rate. Now, the implicit interest rate is one of the most exciting or fun parts of the new lease requirement. And it's become a challenge both to explain and to calculate, but the good news is that it was a huge piece of what the rules used to be when FASB initially rolled out the standard. But as people started to implement the standard, FASB and audit firms and others realized that it was too much fun, the way that FASB had originally written it. Luckily, FASB has simplified it and simplified it and simplified it to the point where most of the time the implicit interest rate comes out to be equal to the interest rate that the company is charging on the lease. However, we still have to go through the calculations and make sure that the interest rates really are the same. So here's the logic. What FASB wants is the payments on the asset. These are the present value of the payments and the present value of that residual that we think we're going to get once we get the asset back at the end of the lease, is equal to two things: the fair market value of the asset plus any deferred initial direct costs. And so we do a calculation to figure out an interest rate that makes those two sums equal. Now, it used to be that that was a real pain in the neck, but with Excel, it's actually not that bad. So let's jump over to Excel, and we'll show you how to make these calculations. So let's start by giving this a title. This is our implicit interest rate calculation. And we'll need two columns. We'll need a date, and then we'll need our values for our calculation. And I'm going to make the date column a little bit bigger. And I'm going to go ahead and format the values column so they come out in the way that I want to read them. So I like the currency format. We'll round to 2 decimal places, make sure that dollar sign's there. And I prefer negatives to show up in parentheses. So let's go through the dates on this lease. The initial value, we are giving to the other company as the lessor the market value of the asset. So we'll put that in as a negative 300,000. Next, we have these deferred initial direct costs. And that would be a negative 4,000 because I'm paying those costs right now. And then the company is going to pay me today, first payment. And we said that would be $56,825. That's what they're going to pay us. Which means, if I add that up, I'm going to hit this increase indent button. We're going to have a January 1, year 1 value. It'll be the sum of all those values. And you know, I'm going to get rid of those decimals. It's making it a little harder to read. There we go. So right now, today, that's the cash outflow on this lease. What we give them, an asset worth $300,000, we pay these initial direct costs, they give us this $56,825. Then we're going to have these other payments. We'll have a payment on January 1 of year 2, January 1 of year 3, January 1 of year 4, and December 31st of year 4. And we'll indent those. We've got a little bit bigger. So what's going to happen on January 1st each year is I'm going to get that $56,825 again. And I'm going to get it again here for a total of 4 payments by my lessee. And then at the end of year 4, I'm going to get back an asset that I think will be worth $100,000. What an implicit interest rate does is it says, figure out what makes these numbers equal to that number. And I'm just going to tell you right now, in order for Excel to do this calculation for you, you have to show the outflows as negative and the inflows as positive, because you have to have a negative value compared to a positive value. That's the only way that Excel can make this calculation. So we show the cash outflows or the assets that we pay out as negatives and the money we get in or the assets we get in as positive values, and then Excel can handle it. The equation in Excel is really, really easy. Excel calls it the internal rate of return. So it's IRR, parenthesis, we then highlight the values, the negative number, and then these positive numbers. We've got a negative coming in today. We've got positives coming in over the next 4 years. And that's it. So basically what this interest rate means is that over the life of the lease, we're going to give away an asset of $300,000. We're going to spend an initial $4,000. They're going to pay us back $56,825 4 times plus $100,000. The actual return we're going to make on our $304,000 that we're shelling out is 3.3712%. That's what that means in English. Now watch what happens if we get rid of these initial direct costs. If they were nothing, there's our 4%. Because when we did our calculation as a company, we said, okay, we want to make $300,000. We're going to require a lease payment that returns us 4% interest over 4 years, plus we'll get that $100,000 back. We're charging 4%. So as long as there's no initial direct costs or nothing else that we have to shell out, we're going to make 4%. But if we have to pay extra, now we're not making as much anymore because those initial direct costs drop our value. And that's what this implicit interest rate does, is it equates the reality of what we're really paying to make this lease happen, the asset and the initial direct costs, with what we're actually getting from our lessee. So that's what we're doing. Now, as I mentioned earlier, FASB decided to simplify this. They said we're only going to include the initial direct costs if they're deferred. And we only defer the initial direct costs if it's a operating lease or a direct financing lease. For a sales type lease, we recognize initial direct costs as an immediate expense. In other words, for a sales type lease, these are considered part of making our sale. They're costs for this year. They're not considered part of the lease. So in a sales type lease, I'm going to make this 0. Which means that most of the time, you're not going to have an implicit interest rate that's different from the interest rate that you're actually charging to other companies. Which makes this really simple, unless I'm doing that special direct financing lease that we talked about a few minutes ago. I really don't even have to worry about this. Be aware, there are some other times when this does kick in if you actually are charging more than the face value, or if there's some other cost that you didn't anticipate, etc. But for most of the basic leases that we're talking about, you're not even going to have to worry about this for a sales type lease. So we've done the calculation. This is how you do it. Conceptually, you need to be aware that this is what we're doing. Now, understanding when to include or not to include the initial direct costs is a really important part of the new lease standard. So it's also one of our key concepts. Remember, the rule is we only include the initial direct costs if they are deferred. If they're recognized immediately, then we consider them a period cost and they don't go into the calculation. And for the examples that we're doing, that means that we're actually not going to see a different implicit interest rate very often. So let's go back to our table. Now that we've done this, we know that our implicit interest rate on this sales type lease is 4%. Now that we know the implicit interest rate, we can do our present value calculations. You can do this with a table, but it's probably about time that you learned how to do it with either a financial calculator, which as an accounting major, you should have one because we do that kind of stuff in accounting, financial stuff. So if you don't have one, you should get one. If you don't have one, or if you want to be faster about it, instead of using the tables or calculator, you can do it in Excel. And this is really important, either having a calculator or being able to do this in Excel, because if we have to include those initial direct costs, you're not going to find an interest rate like 3.3712 in the tables. They only do whole numbers, 3%, 4%. This isn't in there. So a financial calculator will do this, so will Excel. In Excel, we use the PV function. So equals PV, present value. We'll use our rate, 4%. We have 4 periods, so we'll use a 4. Our payments, if we're talking about the lump sum, the $100,000 that we're going to get back at the end of the lease period, then this is a 0 because I'm not getting anything until this $100,000 that I'm going to get at the end. And that's what that FV is, either fair value for the fair value at the end or future value, what we're going to get at the end. And then payments for this lease are made at the beginning of the period. So I'm going to do comma 1 and hit enter. Now there's my value, but you'll notice that Excel has this really weird thing that it does. It makes it negative. And so I just have gotten in the habit of putting a negative in before my PV calculations just so that I get a positive number because that's what I want. So let's go ahead and go back. And the present value of our residual of that $100,000 was $85,480. And now we can do the same thing for the lease payments. Again, I'm going to use a negative PV. My rate is the 4%. Number of payments will be 4. For the payments, there is a payment value. So I'm going to click on this $56,825. Once the payments are done, though, they owe me nothing else. So that's going to be a 0. Again, payments are made at the beginning of the period. So I put in a 1 and I hit enter. And there's the value of my lease payments that I'm going to receive. The present value of my lease payments. $214. Now, what we want is our actual lease receivable. And we're going to estimate our lease receivable as the total amount that we're going to get back from our lease, which is $214,520 in present day dollars in payments, plus $85,480, again in present day dollars, in the value of my leased asset. I'm going to get that $100,000 back at the end. If I add them up, you'll notice that comes out to $300,000. And as long as these interest rates are the same, then this value will equal this value. And then I can bring this number down here and complete my amortization schedule. Now you know how to do that, so I'm going to let you do it instead of doing it for you. Remember though to use the implicit interest rate. Just get in the habit of linking to that implicit interest rate or using that implicit interest rate and not the interest rate that we're charging our client, so that in those rare occasions where you do end up with an implicit interest rate that's different than the interest rate that you charged, you'll still get the correct values in your amortization schedule. So I'm going to stop here and let you complete that amortization schedule. When we come back, we'll pick up with what the journal entries actually look like. We'll see you then. Thanks.